Well, a crisis was averted in Washington today as the Congress got together and finally passed a temporary budget measure, at least kicking the can down the road for a few more weeks before they have to do this all over again. Market cheered it nonetheless and continued higher to new all-time highs. So I'm going to break all that down as I always do to try to gauge some expectations going forward. And then looking again at to where's the money rotating to, and how can we take advantage? So that's where we go with today's trade idea in the sector that's been pretty beaten up on a relative basis. 52-week highs itself, but still on a relative basis getting pretty beaten up by the market, and see if there's some opportunity there. So let's go ahead and get started. Today is Monday, January the 22nd, 2018. This is the market outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those that are watching for the first time. Keep coming back for more. Subscribe, if you haven't already, subscribe to my YouTube channel down below. Click that red subscribe button. You can do it right now while you're watching the video. Also, while you're down there, click that thumbs up. Again, you can do it while you're watching right now. That's one click way to give me feedback. Tell me what you're thinking. Did you like it or not? And do you want me to do this again tomorrow? So that's the way you let me know. Of course, scroll down further and comment on anything that stands out to you from today's video. What did you learn? What do you look to apply going forward? Finally, I've highlighted a link in the video description below down there for you to subscribe to my email list that where I send out daily email, market outlook emails, time-stamped hyperlink summaries of each segment that we go over. To get that email, make sure you sign up on the list. Finally, you can also follow me on Twitter for more content in addition to these videos. You see my handle on the screen up there at DavidSettle42. While you're there, retweet and like today's Market Outlook tweets, always pinned to the top. That way Twitter will keep pushing you my tweets to make sure you get them all. And then finally, join the Market Outlook community. It's on the Facebook groups. There's the address on the screen. There's also an address with a link down in the description below. Click on that link. We're over 800 now, so come join us by joining that group. Let's take a look at the S&P 500 then first with the market forecast indicator here. And you can see we continue to have strong bullish posture, strong long-term sentiment. So obviously it takes more than a day to change those. And really, we've only had, in this run of 2018, which now has gotten to the point of almost a 6% return year to date, 141% annualized return, all pretty much on one near-term run, which is in the fourth month of the current intermediate run, which might not be very long for individual stock, but for the broad market, that's a pretty long extended run given the maturity of the intermediate trend. Long-term market sentiment still high. Again, typically you can go back and see there's not a whole lot of gains once market sentiment crosses 80. We really start to slow down, and the curve tends to flatten out. The curve of the actual price and the moving averages tends to flatten out to the upside. That's hasn't been the case since here. That's when we had the run to get up to that point. And remember, we came up off of 70 pretty much. So that's why we didn't have that much of a run before it got to 80. But since 80, it's been it's pretty overbought. Again, just because it's overbought doesn't mean you have to sell it, right? The overbought trends can stay overbought for a long time. Back in the 90s, back in the, when we were getting all-time highs just about every single day, that's kind of where we're at right now. Very, very strong trend, very strong market forecast indicator. Of course, if you look at the Dow Jones Industrial Average, you see a very similar pattern. The near-term line, momentum line, almost got above 80, so it came close to a bearish cluster, not quite there. You take a look at the NASDAQ Composite. Again, you can see this insane runs we've been getting here. So this is the NASDAQ Composite up over 7% year to date so far. That's 192% annualized return. Just outstanding returns. The market's pricing in, a good earnings season. It's pricing in the good news that we got today from Washington with the budget being passed. Now, granted, of course, they still, you got the debt ceiling coming soon, and they only passed this CR here until for another few weeks before they have to do this again. But the market, nonetheless, pricing in good news, because that's what it does. It prices in expectations for what's coming down the line. The Russell 2000 did not go up as much, but did form another bearish cluster, an overbought cluster, with the momentum and near-term line spiking up into the reversal zone. You don't have all four lines. Market sentiment's rising. It's at 75, not quite above 80, but cluster nonetheless. Again, just means that we're strongly overbought. Doesn't mean we have to come down, but it does mean, and that's a pretty big risk factor, which means to shorten up positions, existing long positions, and then of course dialing back the risk on the new long positions on what we're going to end up, the type of stocks we'd end up getting. So that's what you see. You can go back to the S&P 500. That's what the market forecast is showing right now. So strong intermediate posture, strong short-term sentiment. That near-term line has been above 50 for quite a while now, which is not typical for this late in the intermediate cycle, but that's okay. Again, the trends tend to continue until they don't. So the expectations are we follow the trend. We just need to be aware of these risk factors that we're seeing here and adjust accordingly. But that, market sentiment's rising again. We got up to above 90, which is rare for market sentiment, but that was back in November of last year. We were pretty high then. We're a lot higher now, even though market sentiment is forming a much lower peak. And the intermediate line has been above 50, and especially above the upper reversal zone for so long. It's quite the decent move, and of course I've got the Fibonacci lines drawn. The 100% move retracement of the current near-term run would get us down to the 38% Fibonacci retracement of the intermediate run that we're on, and of course looking at the long-term market sentiment run that we're on that started with the Trump election. You can see pulling back to that 38% Fibonacci on the current intermediate run would basically get us about to the 23% Fibonacci of the move we've had since the Trump election. Of course, if I were to zoom in here, and I've shown you this before, but we'll update it with the new figures now, we're looking at a almost 17% return, or 43% annualized return for the S&P 500 since that election. So quite the move for stocks on this current market sentiment long-term trend, and that was last time the market sentiment got below 50 and then pulled back up above it. So needless to say, this trend is long in the tooth, but also needless to say, it's still a bullish trend. It's still a very strong bullish trend, and we typically don't spike down when the moving average is that parabolic. It's got to flatten out first and allow a lot of these other moving averages to converge with each other, which we're not even close to. And again, the long-term chart just shows how parabolic we're getting, and continues with a new week today. Continue to shoot up at a pretty strong pace, and again, markets don't tank when these lines are moving up at such a strong pace, and the gap between the two is continuing to enlarge and get bigger. You don't get bear markets out of this. You can see just how bullish we've been pretty much since mid-August, with only 1, 2, 3, 4 small down weeks in the midst of this multi-month intermediate trend that we're on. So quite the rally. And again, the longer we stay above the 50, the longer we stay so far above the 200, and not just on the absolute basis, but also on the relative basis, comparing the current gap of about what 100 and what would that be, 170 points for the MACD itself, this line down here. So as bullish as we are, when those things are rising like that, we don't typically expect significant pullbacks anytime soon at all. The 3 green arrow chart again shows all those other moving averages that are involved with the MACD down there, the 8 and the 17 day. The gap between those two continues to rise as we continue to trade well above. I mean, we haven't even sniffed the 8-day moving average for most of this near-term run. That's how strong the run is. And Of course, you can't test the 30, much less the 50 or 200, until you at least test the 8. It's a stair step, right? You ride that short-term moving average up, then you break it and start to test the 17 days. We start to flatten out, and then as those lines converge, then you get the green arrow on the 6 week, the 30-day moving average, and of course breaking through all those eventually leads to more weakness. But as of right now, not anywhere close to even touching the 8-day moving average. So another indication here of riding the trend. Here's today's intraday chart, which is as bullish as you can get, opening at the low of the day, closing on the high of the day practically. You can see the rally from Friday's morning lows up to today's high, about 3 points of a move, and again the gap between, and we did close up above last week's high, close up above yesterday's high, moving the 4-week average up, and you can see the 4-week average. Again, we won't move this low point up for another about a week plus 6 or 7 trading days there. We'll start to move it up, so which means that gap is just getting bigger as they push the top end up. Almost 15 points, more than 15 points now. About 15 points. Oh, excuse me. Yeah, about 15 points, about 16 points there, from high to low, which is a large absolute number. And of course, on a relative basis, it's getting it can get bigger and bigger because the price of the index here, the SPY, is getting bigger and bigger. But still, that's quite the sharp move. And again, we don't start getting more bearish until we're at least trading closer, in the lower half of the chart, much less testing the lower end of the 4-week range. And right now we're testing the upper end. So that's the trend, that's where the risk is. And as of right now, it's probably where a lot of the pain trade is. A lot of people thinking it's as overbought as it is, it should come down. And of course, if you're acting upon what it should be doing, then you're going to be feeling a lot of pain as it continues to do what it actually is doing, which is trending higher. 1 days don't make a trend. There's been a lot of up days which has constituted this trend, so the trend is higher, and of course that's what we're trying to figure out. We're not trying to figure out what's the S&P going to do tomorrow. We're trying to figure out which way is it trending, what are our expectations, and how likely is it that we're going to see a change in trend. That's what we look for at these charts for. Now, if we take a look at today's range, as you can see, it's a pretty large range. And again, we're not supposed to get big ranges. We got slightly higher than average at 91 million shares traded. The range, you can see the R over there, is 2.58. So it's quite the move. I mean, in context again, 2.58 is off the chart from a 52-week average range, and then 90-some-odd millions at the top of the chart. So these figures aren't typical for bullish moves. And so, yeah, great. It's great that we keep going up, and things like some of the stocks we've been looking at. Netflix has been going up, has had a great earnings announcement in the after hours today. Halliburton's continuing to go up. It's looking really good. So a lot of the stocks that we've looked to buy, much less the active trades, option trades, but the stocks in recent videos have been doing really well during this move. Right? Everything pretty much has been doing really well, except for utilities and real estate. During this rally here. Just because we're as overbought as we are doesn't mean we have to avoid any long positions. They're going to do well in this environment. We can ride them as long as we can, reducing position size and taking risk off the table, which when you have winners, the risk is losing your profits and then getting down your stop orders. So you just continue to ride these higher. You don't want to move your stop order up too much because we're way up above moving averages. We're way up above low points, most likely for a lot of the stocks you're in. So moving up a stop order to a weaker support level or to no support level at all will just get you whipped out of these trades. So you want to keep your stop order below support, and as you get further away from that support on an impulse move, then the way you protect yourself is you reduce risk. You take some profits off the table. You reduce your risk until you get a pullback, a new set of 3 green arrows, for example. Then you can add back in that position to build it up as it makes a new wave higher. Volatility came down, but it's not coming down nearly as much as it has before. We're coming up a higher volatility than we've seen over the last few weeks, 6 weeks or so. Remember that during this whole time, the S&P is new highs every single week practically, including this week, including last week. But the volatility got to a new high last week, to the point where now we have almost a 4-point range, from 9 at the beginning of the month to almost 13 on an intraday basis last week. So we're coming down, forming what could be a higher low point between 11 and 1050. There's some resistance on an intraday basis. Keep in mind, support everything you can read on the chart, on the daily chart, you can also do on an intraday chart. But just remember, when you get more signals, you get a lot less reliability, and vice versa. When you're looking on a really long-term chart, yeah, you're not going to get very many signals, but you're going to have a lot more reliability. And just know that it takes a while for those signals to play out. It doesn't take as long for these signals to play out when they're right. They're just right less frequently because of the time frame. So pullback, obviously potential for a higher low point if that ends up going on. And you can see even on an absolute basis, we've pulled back down to about 85% here, where the old highs were. So similar to the VIX on an absolute basis, the VIX on the relative basis here to a further month back, 3-month volatility index, we're basically pulling down the support, which was an old high point, and we'll see how it reacts to this and bounces. If volatility continues to bounce, we continue to get higher numbers and higher volumes. That's not a sustainable model typically, unless you're needing to break through some resistance. Not the most typical sustainable models. Sustainable bullish trending models are ones that have where volatility is dropping and trading ranges are dropping and average volumes are dropping, and that's just not the case over the last couple of weeks. You can see over the last couple of weeks, the dollar and long-term bonds have been the biggest losers, down almost 2% to 2.25%. Gold has been struggling too, but at least up relative to the dollar. You can see it has not been up relative to crude oil, and that's, usually it's that relationship between commodities and metals, precious metals, to determine whether or not economy is growing or if people are moving to safe haven. In this case, economies are growing, not just here, but abroad, because you can see, emerging markets and developed markets, after years of underperformance, are outperforming, and the best performing asset class today ended up being equities, of course, but this black line ended up being the S&P 500, up over almost a full percentage point in the last 2 weeks. And of course, if I were to go out to the 4-week chart here, then you can see it's emerging markets and crude oil both taking advantage of a strong weakness in the US dollar. In fact, pretty much from this low point, this high here, going forward, you can see emerging markets and crude oil initially, developed markets are up there over 3%. And of course, the dollar down 2.25%. Long-term bonds coming down pretty sharply, now down 1%. And of course, junk bonds, high-yield bonds down as well, and gold rallying on the weakness in the dollar. So pretty typical patterns. When you look at just today's in a vacuum, we can see how important it is to have exposure across different equity asset classes, as large caps had a great day and not as good for small caps. Good, positive, but still not as good. And typically you want to see it outperforming large caps. And international stocks both doing well too because of the weak dollar. But typically I like to see emerging markets come and outpace developed markets. And it did at the end of the day, but for the most part of the day, at least most part of the afternoon, the developed markets were the best performing asset class. Of course, interest rate expectations are a factor on whether or not U.S. stocks versus international stocks, who's going to outperform who. The Treasury yields are starting to rise, and you can see the 10-year note. If I pull up just a chart of the 10-year note here, pull this up. Give it a second here. All right. 2.6% has been the level this year and late last year to get across, and it looks like we're finally getting across it here this week. Now it's still kind of just barely, so you don't want to put a lot of stock into it, but you get up to 2.75% or closer to 3%, we know that breakout's holding. So long-term bonds rallying, and of course you saw some strength in crude oil prices still, getting up to, let's go to a 1-year chart, daily chart. Here we go, and it's a chart of crude oil here, and you can see it had a little bit of a bounce back day after a little bit of weakness here. Little pullback to bring the MACD down below zero, bring the stochastics down out of the reversal zone, and now the possibility of us bouncing and closing above Friday's low point there. So close above the high of the low day, as that's the lowest low point on the pullback. So it looks like there's a bouncing opportunity in crude oil, and we saw the yields going up, and of course the higher crude oil prices are going to help energy stocks, kind of up and down today, but finish up with a pretty decent return. And of course, the long-term bonds are going to impact, the treasury yield expectations are going to impact bonds. They started strong, but from that point going forward, bonds are down the most, along with gold and high yield and the dollar, all lagging to all safe havens to the downside. Whereas up here you have all your equity asset classes pretty much all doing the same thing, all showing the same relative performance there. Crude oil, of course, spiking early, going from 0.9% gain to almost a 0.5% loss before finishing with about a 0.5% gain. So very volatile day on crude oil, but the pattern suggesting that we may be in for a little bit of a bullish bounce here in the near term. So from today's sector rotation, the energy stocks continue to do well, and one of those stocks in that space that we've looked at before for a trade idea was Halliburton, and pretty representative of how that industry is doing right now. We looked at it, I believe, on the possibly, let's see, might have been on the 4th here on this day. No, actually, I think it was on the 1st, on December the 1st. After that 3 green arrow and with a spike in volume move, from that day going forward now, you can see that we are, with today's move, post earnings move, up 31.5% in 52 days. It's a almost 600% annualized return. So that's a representative of that industry that was lagging so much. Consumer discretionary technology also having a good day today. And of course, one of those stocks, another one of those stocks we looked at for a long position recently is Netflix. And Netflix taking off as well. You can see we looked at on this day here with the spike in volume and the 3 green arrows. Since then, it's up to 227.5. That is a return of, again, from that point till now, about 18%. Not as big of a number, but you can also see in the after hours we're up to 246.50. So we're up almost $20 on Netflix. So that's some representatives of what's doing pretty well here from a sector rotation standpoint. Materials, industrials lagging behind. Those are your two of your energy as well, but 2 of your economically sensitive areas. They should do well when economic expectations are growing, and those expectations are still there. They haven't changed. In fact, they're up a little bit higher. And then the rate hike expectations are also still high and actually rising a little bit. For this is the September contract, and of course, if you go out to December, you're pretty much got pretty decent odds of any kind of rate hike between now and then. But the highest being, that the third rate hike here, as our current rate hike, as you can see, for next March, we're expected to get to 150, 175. That would put the 175 to 200 area in play for June, and then puts the 200 to 225 area right here in play for September, and of course 225 to 250, this one here in December. Starting to gradually grow. Pull back a little bit, but you can see a month ago we were at 10%. So it's been gradually growing here despite the pullback. When you look at the sectors and how they're performing, you can see the sector rotation. The consumer stocks have been the best performers today. And you can see this is actually based on their market sentiment. So their long-term line Who's been more bullish? You can see these consumer stocks, financials. This is a longer time frame, but you can see the real estate, the interest rate sensitive sectors are the ones that are lowest. Telecommunications not as low on market sentiment, but the other two especially. Real estate and utilities are eventually going to add some pretty good opportunities, some good value in there. But one stock in that telecommunications sector that we'll take a look at. So one of the stocks in that telecom sector that's kind of that's actually hitting 52-week highs is Verizon. Verizon's chart actually, when you look at it this way, it doesn't look so bad. It's up off of 43 since middle of November. Breaking through 3 green arrows today with a spike in volume right before its earnings announcement. So of course, if you want to wait for the earnings announcement, if you want to start small, the earnings announcement actually comes out here tomorrow, right? Tomorrow in the morning before the market opens, which means we could get a big move. Now you notice the same earnings we had last year, right there in the same time frame, after having a pretty decent run to the upside, not to new all-time highs like this one. But you can see in November, mid-November to the end of year run, mid-November to end of year run again, not so bullish right before earnings, and you can see the market dropped in them. And when you look at the earnings since then, one drop and then up, two upward moves, that things have been looking better for this kind of embattled company. But there's another way to look at VZ, and that's of course looking at it from a relative strength standpoint compared to the S&P 500. There we go. We'll go ahead and click on that. And you can see from July of 2017 just had a good run. But looking at it from this standpoint, you can see, especially if I were to look at on the long-term basis from 2013, it's been lagging big time. In fact, if I were to take a look at VZ here, makes me want to put a B in front of it, right? Let's look at just at Verizon, and then we'll take a look at a comparison chart of it to SPY, and we'll clear all the other studies here, especially on the top. You get that relative that relative strength line, or that comparison chart back up again. There we go. So from that midpoint of 2013, where we've really started to lag behind, right? So if I were to go back here, and really from that top of April, since then the Verizon's been lagging the broad market. All right, so now we'll take a look back at just Verizon, and we'll go from that beginning of from its peak in the beginning of April till now, and the stock market itself is up, again over, what would that be, April of 2013, so 1, 2, 3, 4, almost 5 years. The market itself, the S&P 500, is up almost 100%, 96%. Verizon is way lagging behind at 24%. So a lot of underperformance, and that's kind of what we're looking for new positions, is some opportunity for relative strength, for underperformance, for value. You can see the dividends, relatively cheap PE. Dividends still pretty attractive at a decent yield, not as high as it's been, but a decent yield. And then of course you have the earnings tomorrow. So this will be a play where, of course, we can't do anything until the market opens anyway, on Verizon at least. So we'll let that earnings play out and see what happens. And if we end up coming in at a better price, we'll take a look at it and make sure it's not like breaking out of Bollinger Bands. And if it does go to the upside, breaks out to the upside, then maybe we'll sell puts to see, to stay bullish, but give it wiggle room to pull back, potentially buy the shares at a cheaper price instead of chasing it. We've talked about that alternative before. Selling puts is a way to get into a position that's strongly overbought as it is, allowing it some freedom to come back. We can keep rolling those puts for credit until we bounce off a new higher low point, and we can look to buy the stock coming up off support rather than after having already bounced off support so much. You can see its market sentiment's already pretty high, so it's had a decent run, but we're banking on this kind of breakout move, and this is a multi-year breakout move, right? So we've we tried to get up here to 52.5. It failed, pulled back down. We got back up there again at the end of last year. We're trading around it, coming back down a little bit at the beginning of this year, and then now potentially finally holding that through. And of course, tomorrow's earnings will make or break that breakout. And if it goes up too much, then we'll look at selling puts to give us wiggle room to the downside. If it goes down too much, same thing. We'll look at selling puts as an opportunity lower than where it falls down to buy shares at a cheaper price and then continue to rally. If it doesn't do anything tomorrow and it just kind of does, an earnings, kind of hovers around where we're trading right now, we can now look to buy the stock knowing that we've got the 3 green arrows in the spike in volume with the potential breakout of some long-term resistance there. So again, big move either direction. We'll look to sell puts to be a little bit more bullish, but more conservative to the bullish side. If tomorrow's earning comes and goes and there's no significant move on the stock, then we'll just look to buy the stock based on the signal. 3 green arrows in the spike in volume that we got today, breaking out of a semi-sideways trend that we've had, if not a bounce off of a higher low point. Again, go back to that daily chart, bounce off a higher, pretty sideways trend because we moved so fast when we were consolidating, and now this may be that bounce up that brings the intermediate line back up and potentially stay up for quite a while. And you can see the momentum line spike to a extreme high to help change that weak bearish posture and turn that intermediate line back up again. So to summarize, the market extended its rally and it's being led higher by international stocks, by emerging markets, by crude oil. Dollar weakness has had its impact, and of course the fiscal, the fiscal situation in Washington's really provided a lift to these equities, and the trend is extreme and it's overbought. But again, trends can last for a while, for a long time, and so we'll ride that while we can, looking for bullish opportunities that have value or have something to them as we rotate from sector to sector, and the market looks for opportunity. Remember, energy had been down so much, and now is one of the relatively stronger sectors. And today's trade example looks at another area that's been down so much for good reason with these rising interest rate hike expectations, but now showing a breakout on one of its bigger players in that area, and we try to take advantage of that breakout. Remember to subscribe, like, and comment on the video down below here on YouTube. Follow me on Twitter, like today's Market Outlook tweet there, and share it. And then finally, join that Market Outlook community on Facebook if you haven't already, to have this discussion and others with other people that watch these videos like yourself. That being said, thank you all. Have a great evening. We'll be back on tomorrow and we'll do this again. All right, we'll see you tomorrow, everybody.